Hey, Market Chameleons. Thanks for those who have joined us on YouTube Live. We're going to start the webinar in probably 30 seconds at 6 o'clock. I'm starting the webinar now, D. All right?
Yep, sounds good. And
All right.
welcome everybody. Thanks for joining us.
The webinar is now live on Zoom, and we have quite a few participants. Let me know in the chat if you can't hear us. Dmitry will give his presentation tonight, and then if you have any Q&A, just put them in the Q&A section in the Zoom meeting. Everyone who's on YouTube Live, just put your questions in the chat. We have like 25 people on YouTube Live, so that's pretty cool. And with that, do you want to get started with the disclaimer, D?
Yeah, let's do that. We'll get that out of the way real quick. So Will's about to put up the disclaimer, everybody. This is just letting you know, Will and I, we're Market Chameleon. We're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas here. If you need professional advice, then go call your investment advisor or your broker. They should be able to help you out. There's a disclaimer.
Excellent job with that disclaimer as always, Dima. Listen, I will also put out the link on YouTube Live to the webinar because sometimes the connection between the two can leave a fuzzy imprint on YouTube, so that could be helpful for you. Also, I'll put a link to our subscription to YouTube because we're constantly putting out videos and we have a morning show, and it's a great way to get notified, don't you think, D?
Yeah, exactly. I think YouTube does a great job. So once you subscribe to that YouTube channel, and if you're interested in that content, that they'll send you a notification once we go live or we put out a new video tutorial, you'll get notified from YouTube. So
excellent.
That's a great way just to stay connected.
It looks like everyone can hear us, and you can start whenever you want, Dima.
Okay, awesome. We didn't have a survey this time around, right?
We did not have a survey out there, no.
Okay, no problem. So I'm just going to continue on what we've been building upon in kind of the last 3 videos. We talked about just simple call options, simple put options. I went over just how to read the options chain. And this question came up, well, what are these guys over here in the middle, the Theo values? So we know when we're looking at, and this is an SPY options chain. What we did last week was we just talked about, how to find the call prices, the call bids and offers on the left-hand side, the put bids and prices, bids and offers on the right-hand side, the different strikes and the different expirations. So very basic tutorial on how to read an options chain. And we did get a lot of questions about this middle column. What are theoretical values? And before I get into that, I created just a little slider today. Let's start out with this, what we're going to talk about. So for theoretical values, we're going to discuss what is it? Why do traders use theoretical values? How do you determine a theoretical value? How do you calculate it? And why would the price diverge from a theoretical value? All right, so that's what I want to cover today. I'm going to try to make it as simple as I possibly can. All right, so this isn't it's an important topic, but it's not very simple to explain. So I'm going to try to do it in as simple terms as I can explain it. So let's just start out. What is a theoretical value? And theoretical value is an estimated value of a financial security. And usually you use some kind of a model and assumptions to estimate that value, right? And your assumptions can be based on historical data or your projections, but whatever assumptions you have, you're going to input into a model, and then you're going to create a theoretical value for that financial instrument. And that's done in lots of places in the financial field. We have them, the insurance companies, right? They create theoretical values. What is in it? They estimate what an insurance policy should be worth because they don't know exactly, who's going to get into an accident and when is there going to be a storm, who's going to die with life insurance. They don't know all that. They start making estimates based on a model. So lots of financial instruments have theoretical value models that create theoretical values. And we're going to kind of go through a simple example of one of those. And why do traders need theoretical values? Well, they become very important because it helps you make a trading decision, right? You'll be able to estimate your potential gains, your potential losses, create a risk and reward analysis, and you want to see how far away are the market prices from the expected value. That will also help you make better trading decisions. So, even what is it? So why do we even have like a theoretical value? Because some people, well, we have the market price. The market price is the market price, right? But it's when you're trading, when you're doing trades and stops and options, whatever it is, you're trying to trade for profit, right? It's not like a painting where you might like this painting, here's the market value, and there's only one of a kind. Either you buy, and either that you buy it or you don't. That's not really how stocks, right? You're not buying a stock to put it up on your wall. You're doing it because it's an investment. You're trying to make a profit from it. And that's where the valuation models become very important to compare to price. And I'll just give you like a quick quote. Maybe I'm not the best at explaining it, but I'll just take Warren Buffett's quote that I always say here. And this is how he described it. Price is what you pay, value is what you get. All right. Price is what you pay, value is what you get, Warren Buffett quote. So that's kind of the difference when we compare market prices to a theoretical value. Let me blow this back up. And how do you determine a theoretical value, right? Like, that question comes up. Is there just one way everybody determines a theoretical value and everybody comes up with the same conclusion? And no, that's not the case. So there's no one way or right way to come up with a theoretical value. There's different methods, and different methods could actually give you different results. So you have to understand the methods you're using, the results, and how to help you make better trading decisions. The whole point of view is you're looking at it as what is your potential, what is the potential reward versus the potential risk that you're taking, right? Because when you're making an investment, it's always what is my potential reward for the risk that I'm taking. But there's no one way to actually calculate it, right? There's no one model and there's no one set of assumptions that you could just say, this is what you do. And let me give you an example, all right? Let's take a look at this example. And to simplify it, I'm going to try to use something that everybody kind of is familiar with as a house, right? And you're buying a house, and maybe you're buying it as an investment, and you see that the market price is $200,000. Well, now you have a price. Well, how do you determine, is this a good investment or not a good investment? What do I think this price is? What do I think it's even worth, right? How do you make that evaluation? And let's just take a look at different examples, how we could look at it from different perspectives and maybe even get different prices for the valuation. So now we got the market price. What do we do? Well, one way we could do it, and this is probably something everybody's familiar with who had a broker and shopped around for houses, right? They'll come and say, okay, here's a house. Let's look at the comps. Let's look at what a similar house in that same street or in that same neighborhood sold for. So let's just say these are our data. One sold for $210,000, one sold for $190,000, one sold for $195,000, one sold for $199,000, and one sold for $195,000. So we could take the average of all those houses and say that the average price for that house in that neighborhood is $197,800. That's the average. That's the average price it sold for. The market price is $200,000. Now you kind of have two numbers to compare. Maybe you negotiate, for $197,800 and $199,000, or maybe you feel that $200,000 is fair, or maybe you feel like, hey, $197,800 is the average price, but this is a fixer upper. I'm going to go $185,000, $190,000. So now you have a benchmark and you see how far away it is from the benchmark, you could start making better decisions. You could look at what is the median price instead of the average, take out the outliers. And you could also just tell, well, if I'm paying 200,000, how many out of that average, how many sold above 200,000? So we could see only one up here for 210. How many sold below 200,000? 4 of them. See that below? So 20% above 200,000, 80% below. All that is information to help you make a better trading decision. If you didn't have these numbers, all you're looking at is price, right? That's what you're doing. Now you have a price. Now we built a simple valuation model to see how far away is the price from where we expect it to be around. Okay. Hopefully that kind of makes sense. Well, let me know if you're seeing any kind of questions along the way. If not, I'm just going to keep moving.
Yep, keep going. People, put your questions if you're on YouTube Live in the chat, please. And same, we'll just do right off the chat. Any questions on the Zoom meeting as well. Thanks, D.
Yep. So here we go. So then we made now, as you can see here, I could also change the assumptions or change my model as I'm watching here. I could take this from 1 year and go to 2 years, go to 3 years. Of course, is that a good idea? Who knows? When I'm looking at 1 years of data, it's more recent sales. Maybe 2 years or 3 years, the situation was much different in the neighborhood. Maybe those are not even relevant. But as you can see, there's no, is 1 year the best, is that the best amount of data or best data set to use? You have to make, in a lot of times when you're doing these models, you have to kind of make a judgment call. What is an appropriate amount of data? Do I take out outliers? Maybe this 210 was an outlier and I should take it out of my equation because that's the only one that traded above 200,000. So a lot of decisions you have to make and when you're looking at the data. So you could see just from this simple example, there's no one right answer just using these 5 data points in our average. So let's take a look at a little bit further. Maybe we want to add to our inputs. So we see here 5 houses sold, and we realize, and then we look up these houses and like, oh, you know what? This one for 200,000 has something, an upgrade that I really want. It has a pool, but the other ones didn't have a pool. So maybe that pool to me is worth it. It has a lot of value because otherwise I have to go and buy this house and build it myself. So you might create your own theoretical value and say, well, this pool is worth $25,000 to me, because I have to go, maybe even, it might even cost me more than that. So if the average price that these houses sold for were $197,800, if I add a pool to that, 25,000, then really to me, the theoretical value of this house is 222,800. And I could buy it for 200,000. So all of a sudden, something that seemed a couple $1,000s high now is $22,800 below my theoretical value because that's what this is worth. So you see how things changed all of a sudden? I added a variable because I'm analyzing it a little bit deeper. But what if I and that's one way to look at a model, but there might be different ways to evaluate this same house from a different perspective. Maybe this is an investment opportunity for me. So let's take a third way of looking at it. Now I'm going to change the model up completely. And I'm not going to value it based on the prices they sold, because this to me is an investment property. I want to know what are the rents and what is the market, the cap. What is the cap? What is that called, Will? The rent.
Cap rate.
What is the cap rate of these houses? So here we go. So this house that sold for 210,000, the annual rent on it is 21,000, which gives it a cap rate of 10%. So 10%, of 210,000 is 21,000. That's your rent. Cap rate 10%. This one sold for 190,000, has a rent of $20,000. That cap rate is 10.5%. and so on. The one sold for 195,000, that's renting for 22,000, a cap rate of 11.3%, and so on. So now I have the cap rate of all these 5 houses. So I see that the average price was 197,800. The average cap rate is 10.2%. So now I'm looking at this house that I'm going to buy for 200,000. I'm going to determine, well, it's 200,000. What is this house worth to me? Is it worth 200,000? Is it worth more, or it's worth less? And I find out that the rent on that house is $23,000 a year. So this one that's for sale is paying $23,000 a year. So in actuality, the cap rate on this house is 11.5%. You could see that's higher than any of these, close to this 11.3%, right? But it's higher than any of these, and that cap rate is well above 10.2%. So all of a sudden now it looks like a pretty good deal, even though here's the market price, 200,000. The average price they sold for is 197,800, but I'm valuing it based on my return on my investment cap rate. So what is this theoretically worth then? If I'm getting $23,000 per year, and I think the average cap rate should be 10.2%. So I'll take, can you see that? Take $23,000 divided by 10.2%, the average cap rate. So theoretically, this house is worth $225,490 if I use the average cap rate. Does everybody see that?
Everyone
so my
see that?
theoretical value, 225,490, the market price is 200. So I just created a different valuation model for that house, different than just looking at the average prices that it sold for. Again, the idea here is, all I'm trying to do is show you there's no one right model to look at it. You could dissect it and look at it from different perspectives. Let's do one more. What if I did the following? Maybe I'm looking, should I rent? Should I build a new house? I might, maybe it's better just to build a new house. So let's just take a look at a different way of evaluating. And I'm like, okay, these houses for sale are 200,000. What is the replacement cost of this house if I build a similar house, bought the land, and built that house? So let's just say there was inflation, tight labor market, whatever it is, and this is what I came up with. In labor, it'll cost me 150,000. Material will cost me 50,000, and the land will cost me 50,000. So the replacement costs, or to replicate this house, is 250,000. So that's a different way of evaluating it, right? Because if it's 250 for a similar house, maybe these houses right now are for sale for a better price. Maybe I'm better off doing that. What if I'm a builder though, and they were selling at 300,000, and I'm looking at this? So all of a sudden, the value of this house is 250, but the market price is 300. So there exists an opportunity, right? Because the market prices and my value from it is diverge. So I could build it for 250, sell it for 300. Does that make sense? Hopefully everybody sees that I just used 3 different methods to create a theoretical value of this house.
Does everyone understand what Dmitry just went through?
If everybody's okay, I'm going to keep moving.
Yep, you can keep moving, buddy.
So this is the point, that I'm trying to make. There's no right way of doing it. There's no one way of estimating it. There's just different methods that you could apply. Okay. So that's the point I was trying to make. And the reason we do it is because we want to see where the market prices now based on my assumptions and theoretical value of where approximately they should be, my estimate. Okay. That's the point. So let me see. So the next question is, well, why would the price and value diverge, right? Why aren't they always exactly the same? Well, that's because that's how the markets work. Markets work on supply and demand, right? Why would people sell their house below what you think it's worth or what your estimate is, or below? Because they need the cash maybe, and there's not enough demand right there. Maybe they found a better deal. They found a better house, so they're okay with selling it to you $20,000 cheaper because they're buying something that's worth $80,000 better to them. But that's how the market works. Or why would people overpay? Well, that's the enthusiasm. You know, there's not enough supply out there, very high demand. So things are always fluctuating, right? So that's why we're seeing prices constantly moving around during market hours, and obviously in our economy, that's how it works, because there's always a transfer risk, right? People are getting in and out of stuff, and that's why the price can diverge from a value. So I think that's the end of my slide. If everybody's okay with that, let's jump to the options chain.
Everyone seems okay. D, you can jump to the options chain.
Okay. So I'm going to close these. So here's an SPY options chain. And I just went kind of to a September 11th expiration. So this expiration, you can see, has 8 trading days to go. And let's take a look at, now these are a couple different models that you could drop down and select. So remember, no really one way of doing it, but you could use different models to see what is the theoretical value based on those assumptions. So when you use a pricing model, like the options pricing model, Black-Scholes, binomial, which in this case, that's what it's set to right now. The way that model works in a simplified form is it looks at the volatility of the stock. You enter in your volatility assumption, and then it creates what this option is approximately worth. So then it estimates the value of the option. So let's just take a look at an example of, and this is a little bit, the option pricing model is a little bit hard. I'm going to do a simplified version as I can. Okay, so I'm just trying to simplify this explanation. If the stock, where's SPY? 349.38. Okay, so right now we know that or over here actually ended up 350.33. This snapshot was taken 30 seconds before the market closed. So SPY is $350.33 when the snapshot of this options chain was created. Let's assume that the volatility in the next 8 days, next 8 trading days, the volatility in that stock is 0. Okay. If the volatility is 0, what does that mean? That means that it will not move from that price. From now till the end of that expiration, volatility is exactly 0. That means it's not moving up or down. It's staying exactly at $350.33. If that happens, what is the value of this option? 300. Does anybody know the value of? Let's take an option of $352. What do people think the value of that option is with a 0 volatility? Anybody guessing?
Any guesses on the SPY 352 expiring Sep 11th?
So basically, so right now,
someone said 0. Someone said $2.
Okay, so for this option, the 352 call they might be looking at the put. One's looking at the call, one may be looking at the put. So for the 352 call, for it to have some kind of value at expiration, the stock has to go above 352. Okay, so if the stock goes to 353 on September 11th expiration, then this option will be worth $1 because the stock went $1 above this strike price. If it goes to 354, then this option will be worth $2 because it's $2 above the strike price. So if I give it a 0 volatility, that means it'll never move above 353, which means it will never get above 352. That means this option is worth 0, right? There's no chance of you making money because it needs to go above 352. When I start increasing that volatility, right? When I start increasing that volatility, then the option starts to gain value, depending how much volatility I give it. So here's 351. I mean, right now the stock is 350.33. Let's just say in the next 8 days, it has a small volatility. I'll say, you know, whatever, like 0.1%, you know, or whatever it will equal, let's say $1 up or down. So let's say the most will go, the volatility is $1 up to 351.33 or $1 down to 349.33 based on that volatility. So what is that 352 now worth, that call? Anybody guess? What would you pay?
Put your guesses in the chat. I'll toss them to Dmitry. While we're waiting for those guesses to appear in the chat, I will again on YouTube Live, and I'll also put it on because we've got a bunch of people on the Zoom meeting. I'll put the link to our YouTube channel. Suggest again, it's very important to register for that channel. You get a lot of heads up to videos, our pre-morning market show, our library. I think our library is up to now 400 plus videos, Steve, a lot of stuff. So I'll put that out for everyone.
Okay. So any guess, if I give it a volatility up or down in buck from 350.33, what would you pay for a call that's $3.52? I mean, $352.
We got one guess from 215 from Christine, 3.68 plus the delta from Naheem.
So remember, I gave it a volatility that from this price, from 350.33, the most is going to go is up $1, and the most it's up, and the most is going to go down is $1, based on my volatility assumption, up or down $1. So what would you pay for the 352 call?
A bunch of people are saying zero.
Zero, right? Because if it can't get above 352, this option is worth zero, right? So if I'm saying the highest it's going to go is up $1 or down $1, then this option is worth zero. So if I increase that volatility and say it could go up $3 up or down, up 3 or down 3, or up 4 or down 4, as I'm increasing the volatility, saying it could move away more from here, these options start to gain more and more value. That's how the option pricing models work. The volatility expectation is important in the option pricing model. You pay more premium if you think that the stock is more volatile. If you think the stock is going to be less volatile, it's less premium. Okay, so hopefully people got that, where as I'm increasing the volatility assumption in the model, the prices, these prices in the calls will go up, and the prices in the puts will go up. Okay, so that's one way in the option pricing model. What else do we see though? Like, why do we see, if everybody, you know, knew, right? If there's really smart people and they knew exactly where this is going to be in 8 days, right? If everybody knew exactly where it would be in 8 days, like let's say 356, right? So we would know this option would be worth $2 at expiration. We know these puts would be worth 0, right? But what we see is that the calls and the puts all have values, right? A lot of people, right? All these have bids in the puts, all these have bids in the calls. So why is that happening? Well, the other thing that's inside the model is a probability distribution. So those are the two things really you need to understand about options. Very important is the probability distribution when you're valuing an option. So let's just take an example right now. If I told you here, let's stick with this 352 strike, and the call, and we want to create a theoretical value in this call, the 352 call. Okay, this is my question. If I told you with 100% certainty, I'm 100% certain SPY at the end of this expiration, September 11th expiration, 8 trading days, SPY will be exactly $354. Okay, it'll be exactly $354. What is this call worth? Let's assume no dividends, no interest, interest rate 0, you could borrow as much as you want. And let's assume no dividends, none of that. What is that option worth if you know with 100% certainty SPY is $354?
Well, Mr. Wang jumped in first. He said $2.
$2, right? Because
Nick said $2. So we got a bunch of $2-buckers.
All right, very good. So hopefully everybody sees that, okay? Because here's my next question.
Oh boy.
All right. So with 100%, we see that this is worth $2 because the stock is $354. Everybody, right? So if I could buy it at $352 and sell it at $354, it's a $2 profit. So I'm willing to pay $2 for that option. That's at least what it's worth. That's if I'm 100% certain. What if I thought this? What if this was my assumption? I think 50% probability that SPY will be 354. Okay, September 11th. 50% probability. Should I put this in a notepad, Will?
Sure. A notepad would be good. People love when you go to the notepad.
All right. So, oh, wait. Yeah, let me see notepad. Okay, so what if I thought there was a 50% probability that SPY will be 354, okay, at expiration, and I thought a 50% probability SPY will be 350. These are the only two probabilities, okay? What is the 352 call? What is the theoretical value of that call? Anybody know?
Any guesses out there? We're getting a couple zeros, it looks like.
So look at the 352 call, right? So the 352 call, let me help you.
And a couple ones. One seems
Okay. Right. Okay. Right. Because what happens if the stock is at 354, right? If stock equals 354, then that option will be worth $2, right? $2 because it's $2 above the strike. If the stock is 350, let's make it a little bit easier. If the stock is 350, then that call option will expire worthless because it's below. So then it's worth 0. Okay. So these are the two probabilities right now. So if there's a 50% chance that it's $2, so 50% times 2, right? Plus, I'm not putting it in brackets, okay, guys? So this should be in brackets. Let me do it in brackets because I'm gonna probably get an email saying no, that's not right. All right. So 50% that it's worth $2, right? Plus 50% chance that it's worth 0. Do you guys see the math here? Right? Half the time you make $2, it's worth $2. Half the time it's worth 0. You add that up, that option is worth $1. Okay, so do you see? Now I gave you 2 probabilities. I could give you more probabilities. What if I said, 25% chance, right, that it's worth this, 25, you add them all up, and then you get a theoretical value. So do you see how here what you're doing is these are all a probability distribution, right? That's how these estimates are happening. It's the probability, it's based on the probabilities and estimated payoffs at expiration. I hope I used a simple example I'm not going to go too much deeper in it. See if people are asking questions, did they get it? People, I know you said some people did answer it's a buck.
Some people did answer.
Huh?
Everyone get the example Dimitri's given and the explanation. Does anyone have a question? Just put it in the chat, both on YouTube and on the Zoom meeting, and we'll get those.
Right. So having said that, let's take a look at an SPY theoretical value. So this right now that you're seeing, this is kind of just set without assumptions. It's looking at the market prices. It's generating a regression analysis, giving you a best fit curve, saying, well, based on these implied volatilities, you smooth it out. These are the implied vols. So let's take a look at, so first let's use an option pricing model. Now we don't know what volatility SPY will move in the next 8 days. Nobody knows that, right? Until it happens, we have no idea. So we have to kind of come up with an estimate. Where do we think the volatility will be in the next 8 days? And based on that assumption, what are the theoretical values? And we can compare them to the market prices. So one way is to use historical data and say, well, what was the volatility in SPY in the last 20 days? And we'll use that as our assumption for the next 8 days. And let's compare how far away those prices are. So this is what I'm going to do. I'm going to click the 20-day historical volatility. So in the last 20 days, what did SPY move at? Let's click OK. It's going to regenerate a bunch of theoretical values for us. All right. Maybe I got stuck here.
Hey, while D's making that fix, listen, I don't know if anyone knows, but Mr. Pargamonic here is now a Benzinga contributor. I'm going to put the link to his newest. Well, actually, is it your first article on Benzinga or your newest?
Yeah. Well, this one, yeah, I think this one was my first as a contributor. So Benzinga had articles with, using MarketChameleon, but this is the one, I actually put out there.
So I'm gonna just put a link to that so everyone can take a look. It's worth a read, and nice job, Dima. Very proud.
All right, thanks. So whatever it was, I just had to come in back in and out. So this is using 20-day historical vol. So if I assume that SPY will move at the average volatility next 8 days as it did in the last 20 days, then these are based on our model. These are the different theoretical values for these calls. So we could see here, what is the 352 call that we're looking at? Based on that volatility, the estimated value is $1.65. Right now it's 311, 315. So we see that those market prices are bidding higher, than what we've seen in the last 20 days, right? So that's one way to compare a theoretical value to market prices, right? All these values are much higher. What if we said the last 20 days, maybe that was special and the volatility was very low. What is the average volatility in the last year? What if we just said it reverted, the next 8 days will be whatever the average volatility was in the last year? So I could go here in my models and say, set this to 1 year historical volatility. Okay, so now I'm going to rerun that model. And if I do 1 year, do you see how things changed all of a sudden? Now they look undervalued. So all of a sudden now the 352, if I use the 1 year volatility, that's worth 556. And the market is 311, 315. Which one do you choose, right? Well, that's one of the things you have to decide as a trader. Do I think that volatility is going to remain low, or is that going? Or I think based on other things that I'm seeing, I think it's going to revert back to closer to its historical mean of 1 year, and then these are underpriced. So you see what I did? Showed you two different assumptions. You're going to get two different theoretical values. So, or you could use a mix. You could use, well, what if I said that, I'm going to give 50% weight to the 20-day, 50% to the 1 year? How does that look? I'm going to click that. We're going to regenerate those theoretical values. And you can see even here, these look sort of cheap compared to that 361 implied volatility. I'm sorry, theoretical value versus market 311, 315. So that's using the pricing models, Black-Scholes pricing models. Of course, if you have your own volatility input you want to do, just click on that, change it. Maybe you think the volatility will be, I don't know, 14, put that in there and see based on 14, that's what it is. So it's right now the implied volatility is 15, so maybe way too high. So that's different ways that you could start looking at comparing the market prices versus theoretical values and start making different assumptions. Just like I showed you with the real estate, right? We looked at average prices that it sold for. Do we want to use 1 year of data, 2 years, 3 years? Do we want to use average price, or do we want to use the cap rate, or do we want to use the replacement cost? So you could see here, no one way of doing it. You just kind of want to start testing it out, getting a feel for it. And eventually, as you get better and better, you're going to start seeing that things are going to start clicking more and more. These will start helping you more and more. Now, this is using the Black-Scholes. You could also here use just the actual distribution of prices. So this is using 4 years of data. It's not using the volatility assumptions. It's just saying, show me actual returns over the last 4 years. Based on those actual returns, what are the theoretical values of all these? So that's what this model is over here. You press OK, and that's what it'll show you over here, that if you just use the actual returns over an 8-day period, what is the theoretical of these options? So there's a lot today. I know I covered a lot today, and I try to simplify it as much as I can. Again, it's not the easiest thing to describe, but very important. If you guys have questions, no problem. I'll take the questions now. Hopefully
we had well, keep those questions coming, but we did have a question a little while ago from Hamanth, who asked, where do you get the percent? This was in your example. You were saying a 50% chance of it going up $2, 50% chance going $2. Is there somewhere? He's basically asking, is the delta that percent, is what he's asking.
So the delta is the implied probability. Okay, this is and I get this. You know what? Let me try to explain it this way. So here's what I get from people, and I think you're watching videos and they'll say, well, what is the probability, right, of something? And they'll use like either a delta, or which is not really the probability, or they'll use some version of it through the Black-Scholes model, right? I get this question a lot, and the answer is, and here, let me try to kind of explain to you that. So the official, what a delta is if you use the Black-Scholes model, you could go look at it. Why was the delta created? The delta is the rate of change of the option price for dollar change in the stock price. That's the delta. So if you go look at the formula, that is what the delta is. So it's the rate of change. So what it's saying here is, if you put all these assumptions in there, and this is a 24 delta, that means that this option, that's $1.24. If SPY goes up $1, okay, if it goes up $1, this option is expected to go up by 24 cents. If the stock goes down $1, this option is expected to lose 24 cents in value. Okay, that's the Greek. That's how it's calculated. All right, you guys could go look at the Black-Scholes model, whatever, and that's done on purpose because the model itself is assuming you're hedging your delta, right? So this model, to calculate these, are assuming it has a lot of assumptions. I don't want to get too deep into it, but this is what the delta is for. So people will use it and say, well, this is the probability. This is the probability of profit, right? So I've heard that probability of profit. They tweak the formula a little bit and they'll say, this is the probability of profit. So is this the question?
Yeah, no, that was great. That was great. Yeah, that was the question.
Right. So then they'll say, well, the delta or a different variations of it is probability of profit. And they say use the delta, use that in the market price. So what is the problem here? You know, and this is, by the way, I mean, this is like 95% of the people will not get this. And I've talked to even, you know, professors and with them, unless you really trade, you're not going to get this. But what is the problem of where's this probability? Where's this delta coming from? And that probability of profit? Where's that coming from? It's coming from a model, right? It's coming from a model. And what is the input of that model? What is the major input of that model? Does anybody know? When you're doing a probability of profit, you're running it through a model, and what is the major input? And forget about the dividend. Let's assume there's no dividends. Let's assume there's no interest. You know, okay, there's days to expiration, but what is the major input into that model to get your what they call probability of profit?
Price history.
Well, price history or market price. So it's not price history. How does the model work, right? The model works as you take an option price, right? You take the option price and you work backwards to get this delta, okay? So the input is not price history, but the market price. Does anybody see a problem with that? And that's a major problem because this is what people are doing. They'll say this, oh, here's a delta of 8, right? Well, if the delta is 8, they'll call it probability of profit, right? That means there's a 92% chance that this will expire worthless, okay? So they're looking at the delta saying 8 delta, that means this will expire worthless. That means 92% chance. That means 92% probability I'm going to make money. Does anybody see a problem with that?
Yeah, the time you don't make money, you could go out of business.
Right. But what did you do to get that probability? All you did was use the price, right? Your input is this price. So what would happen if this price is too high? If this is too high, this delta will be higher. If this price is too low, this delta will be low. So remember, you're being driven by a market price, not by any analysis. So let me give you an example. Let me try to simplify it, right? Because this is important. I think people miss it. So let's take a look at this. Let's say we played a game, okay? And I said that, let's just say I said that we're looking at a game with a basketball player who shoots 3-pointers, okay? And in the next 10 shots, right? Let's say in the next 10 shots, you know, for every shot he gets, the payoff is $1. Okay. So he's going to take 10 shots. The payoff is $1. And I'm willing to pay you $4 for it. I'm going to do like a rudimentary, right? Like this is a rudimentary model that I'm doing, try to simplify. So if I'm paying you $4, right? $4, he's going to take 10 shots. If he makes all 10, you pay me $10, right? If he makes 2 shots, you pay me $2, which I gave you $4 for, right? So I gave you 4 up front, you give me 2 back. So if I give you $4 and he's taking 10 shots, let's just work this backwards. What probability am I giving it for price? What's the probability of him making all 10 shots? Or the probability of like 40%, right? I'm just giving you a 40 per, I'm only giving you 4/10 of it, of the value. So I'm doing a rudimentary one here. People get it?
Yep.
If I gave you $10, then I'm implying that he's going to make 100% of all of them, right? All the time. Meaning every time he's going to make 100%. Then I'm giving you $10. If I'm giving you zero, for it, I'm implying there's a zero chance he gets any of them, right? So I'm giving you anywhere in between. I'm implying a probability based on my market price, what I'm willing to pay. Does that make sense to people?
It seems to make sense.
Yeah. Okay. So that's what this is doing. That's what this is doing. It's looking at the price, putting it into a model, and saying this is the delta, or what you would say is the probability of profit. Does anybody see an issue with that? Anybody see an issue with that?
They're asking, what is the issue, D? They need your help. That's what Ed's
So nobody
asking.
sees like the issue with that? Like if that's what you were doing? So what if I gave you $1, right? What if I gave you $1? What would you do? Well, what am I implying? Well, let's say I give you $1 and then the implied probability of profit, I just implied a probability of profit, whatever, 10% over the long term, something like that. It's not exactly, but I'm just saying that if I ran it through a model, it would say 10%. What's the problem with that? Nobody knows.
Well, Ed says it's called reflexivity.
What does that mean?
I don't know. That's a George Soros concept, is what Ed's saying on.
Right. Well, as the markets move, you're just reacting to all you're doing. It's nothing different than just looking at the price as it's moving up. You think, you should be buying. If it's moving down, you should be selling. Right. This is moving along with the price. It's a derivative, right? This is a derivative. It's derived straight from the price, not from any analytics. So how about if I told you this? I will pay you $4. He's going to take 10 shots, right? So you have an option. Okay, I'll sell it to you or not. What if I told you historically, he makes 80% of them? Would that now change your mind?
I think it would change everyone's mind.
Right. So what are you missing here? These probability of profits that you would call, or deltas, have nothing to do with any kind of, analysis. This is only looking at the market price. So if the market price, is this, but you think it's this, you could be way off, right? Because if you're selling it for $4, but in actuality, it might be closer to 8, or 6 or 5, then you're way off. That's why when you're doing that, when you're just sitting there and just saying, well, the market, this is the market, this is it, I'm just going to sell it, you're missing a big piece of the puzzle. It's no different than you don't even need this delta. You could just look at it. Oh, this is a cheap option. I might as well sell it because it's cheap.
Or buy it.
Well, depending on how they feel. I think most people look at it. Why should I buy it? There's only 97% probability. And what is it worth? You don't even know, right? You're just selling it because of this. And that's what people are doing.
Because of the delta, you're saying?
Yeah.
They're saying the delta is. Yep.
The delta, or their probability of profit calculation, which is basically just the same variation, right? It's the same, because what they'll do is they'll enter in when they do it, ask them, what is your input, right? What is your input? And they'll tell you the market price. So what are you doing? You're inputting market price into a probability distribution curve, right? The black shows a normal distribution curve, or maybe you tweak it a little bit, and then you get that. So like I said, all you're doing is like just this part. You're just translating. All you did was just translate this price into this, but it's not an analysis. Hopefully people get that. That's a hard one to understand.
Well, Ed says he's one of the 5% who understands. So,
Oh, thank you. Yeah. Right. But that's how, yeah, that's why we're doing the analysis, right? That's why. Otherwise, all you have to do is just look at these. These are easy, by the way, to calculate. You know, the deltas or your probability of profits are very simple to calculate because all you do is just input the price into that formula. That's all you do. So you don't need any historical data. You don't need any, you know, you don't really need much, really. You just need the price, the dividend, the interest rate, and days to expiration. But hopefully I'll leave it at that. You know, probably went more intense into it than I wanted to, but unless you have any last questions, Will.
well, they're asking about trades, and I mean, we've been at this for almost an hour, and it was super intense. I mean, my mind is bubbling. I know other people have, you know, a lot of questions about MC. They're asking about data. All those questions, I recommend you come. Every morning we have a live show, and though we answer questions like that on the live show. This was strictly the options chain and theoretical value, and who knew it would go for an hour, D? That was pretty
Yeah, no, I was planning on like a half hour, but hey, everybody, thank you for, you know, sticking with us. Thank you for all the questions. Hopefully this was helpful, kind of insightful. And we'll see you guys tomorrow, you know, morning. We'll have the morning show tomorrow.
excellent. Thanks for joining us, everyone. Have a great night, and hopefully we'll see you tomorrow. Have a safe trading day tomorrow. Bye.
Thanks, everyone.